Hello everyone, myself Aditya Vyas, and today we are going to discuss some topics about accounting. First we would understand what are the long-term assets, what is the purpose of journal entries, and some basic examples to understand more about journal entries, how they are performed. So, these are the long-term assets. Basically, long-term assets are a resource a business owns for uh, more than one more than 1 year period of time to generate income. So, if I would term long-term assets, like there are many names like non-current assets, fixed assets, capital assets, and we can also say it like property, plant, and equipment. So basically, if we talk about property, plant, and equipment, they are tangible assets. Like we can physically form and used it in operations like machineries and any equipment we use in it. So basically, it's that. And second one is right of use of assets. Like we leased or we borrow it from other for a specific period of time, and third one is intangible asset. So intangible asset is nothing but it is non-physical asset to provide long-term company revenue. Like we can also say it like copyrights or patents or trademarks we company uh, invests in. And fourth one is goodwill. Basically, goodwill is like a brand recognition, or we can say a extra value paid by a customer to buy something about the company. So it is that. And the fifth one, biological assets like living things like plants or animals used in the production of the company products. So it is like a biological asset to the firm. So the next is the significance or importance of long-term assets. So for a long-term, for the company, long-term assets are most important for their future revenues. So, if we talk about how they also we can say that we can check their balance sheet and we can know that how financially strong the company stands in terms of revenue and profit margin, they are critical to the company's growth and future success. And it also shows when a stock analyst checks the company's balance sheet, he first checks about how much value does the company owns in the terms of assets. And interesting thing is the cash is the most liquefiable asset in the company. So the next is most interesting part, like general entries. So if we remember in the class, our lecture first, we had like our professor Ravin Hannibal sir. He spoke about something about debit and credit. How simply the person named Luca Pacioli uh, termed this accounting term. And basically, general entries are nothing but to record every transaction of the business. Uh, and in simple terms, I have written it like entries are systematically record every business transactions which goes out or in. So this guy is nothing but the Sir Isaac Newton. So I had termed it here him as the his third law of gravity. Like every action has equal or opposite reaction. So on that standards, general entries is same. When one account is debited, another account is credited for the same amount. So it's that simple. So we will learn two general entries to better understand this concept. So the next one is uh, before solving this examples, like we can see this rules of general entries. So this is the accounting equations, like asset is equal to liabilities plus shareholders equity. When our uh, assets are more, uh, we need to debit it, and when our assets goes down or decreases, we need to credit. It's opposite for liabilities and shareholders equity. When our liability or shareholders equity goes or decreases down, we need to debit it, and when it increases, we need to credit it. When we need to record our revenues in credit form, and we need to uh, record our expenses in debit and also the dividends in debit side. So let's understand this easier with a scenario. On January 1st, I bought a car of $20,000 for cash. So we can record it like this, like on January 1, the car was debited because our assets are increasing and the cash is decreasing. Cash is also an asset basically, so it is decreasing. So we can see that the cash amount is credited from it, and this is the description what we did for this general entry. We purchased the car for cash. So this is done, and let's see another example. So for scenario two, it's January 2. I bought a $20,000 car with a loan. So what's the difference between cash and loan? So cash is an asset and our loan is like a liability to us. So on the Gen 1, car is an asset, so we debited it because our asset is increasing, and for the car loan payable, it's like a payable amount, a liability. So we need, if you go back to that slide, how the liabilities, if liabilities increase, so we need to credit our account. So we had credited it, or and for the description it's like a purchase a car with a loan. So that's all. I hope that you understand something simpler about the journal entries. So thank you all, thank you everyone.